Izin rekam.
Selamat malam, Pak Triyono.
Selamat malam.
Izin rekam.
Sorry. Ya. Apa pertanyaannya?
Bapak itu tadi kedubbing suaranya Pak Rahmat.
Oke.
Okay, for Sarah and Cameron, Mr. Triyono is our Vice President. He's joining us. Alright, everyone. Selamat malam semuanya. Terima kasih sudah hadir. Jadi kita akan mulai. Izin share dulu screen-nya. Ya. Jadi ini berapa peraturan sebelum kita mulai. Mohon tulis nama sesuai namanya daftar registrasi. Udah gitu mohon di mute. Sama kalau ini karena webinarnya kecil, jadi silakan kalau mau tanya bisa ketik di chat atau raise your hand, nanti kita akan unmute dan silakan bicara. Ya, perkenalkan dengan Pak Cameron, dia bergabung dengan Longpeaks di 2018 setelah lulus dari University of Colorado as event scholar. Event scholar ini ternyata adalah scholarship untuk golf caddy. Jadi dia persis di short profile ini, Cameron tuh sangat tertarik dengan golf, hobinya. Dia membantu perusahaan untuk membuat komposit dan juga untuk gips dan investment performance. Dia suka weightlifting, main video games, dan lagi mengambil MBA-nya di Colorado State University. Jadi mereka ini sengaja hadir di sini jam 5 pagi di Amerika untuk kasih webinar ini. Speaker berikutnya adalah Sara Celapino. Dia bergabung dengan Longpeaks di tahun 2020 setelah lulus dari Robert Morris University dengan degree di Financial Mathematics. Dia sangat bangga dia bisa mempermudah gips dan performance measurement untuk klien mereka. Sarah juga level 2 CFA candidate. Dia suka skiing, traveling, dan menggunakan fasilitas yang Colorado punya. Colorado tuh di Amerika, mereka kalau untuk skiing tuh sangat bagus. Ya, the time and place is yours. Cameron, go ahead.
All right. Thank you all for joining us here today. We'll be discussing investment performance reporting, best practices, and marketing trends. There will be a more detailed version of this slide deck that we'll make available to your guys' society after this webinar, just so you guys have more information from that. But without further ado, we already had the kind introduction. We appreciate that. So a little bit about Long's Peak. Why are we here doing this webinar? So Long's Peak was founded in 2015. Kind of the focus back then was to help firms become GIPS compliant. The managing partner was working as a GIPS verifier and realized how difficult investment performance in the GIPS landscape can be for firms, whether it's just the resources they have available or just the complexity of what's going on at their firm. Naturally, GIPS is really based on investment performance. So since then, we've kind of expanded to anything investment performance related. And we've had the opportunity to work with all types of firms around the world. So we've gotten really a really well-rounded view into investment performance, whether it's insurance companies in Asia to small startups here in the US, name it, and we've probably seen it over here. So we want to share the knowledge that we've learned from the industry over the years with you guys and empower you to be able to market your performance better.
So one of the major pushes in the industry that we're seeing is for firms to present composite performance. So what is considered composite? We'll start with the GIPS definition. So GIPS defines a composite as one or more portfolios managed to a strategy. So for GIPS purposes, the composite must include all discretionary fee-paying portfolios managed to that strategy. And what's considered discretionary in this context is a bit different than in the legal sense, which we'll get into a bit more later. For non-fee paying accounts, you do have the option to either include or exclude them in a composite. A common misconception is that every account at your firm needs to be included in a composite, but it's only those accounts meeting this criteria, so only those discretionary fee-paying accounts. They're managed to a similar strategy, they need to be in a composite together. Outside of GIPS, the other definition of a composite we see is a combination of related portfolios. So combining all accounts with substantially similar investment objectives. This is a bit of a looser definition in that you can typically omit accounts as long as performance is not materially better with the omission of those accounts. And if you're going this route, firms need to make sure procedures are in place to support this and make sure that omission is not considered cherry picking. Alternatively, you do have the option to show the performance of all related portfolios individually on a portfolio by portfolio basis. We have not personally seen this done in practice. Composites can be quite large, so it can be quite cumbersome to show all that individual performance, but it is an option. So why is composite performance important? Using composites is the best way to show the full picture of how you're managing your strategies, as this is removing any cherry picking by showing the combined performance of all those accounts that are managed to that similar strategy. And this really is becoming the industry norm. So the regulatory environment in at least the US is pushing firms to show composite performance, which is in line with what is required for GIPS. So we expect this shift to showing composite performance to continue to grow and continue to become the norm across the industry.
So we understand what a composite is, so how are we going to calculate that? So there are multiple methodologies that are allowed. There is no one methodology that's superior than the others. Really what's important is that you choose one. Typically this is going to be based on the software that you're using is usually going to dictate this. But it's really important just to stay consistent and apply that, not choosing one because your returns are slightly better with using that methodology. If you switch systems, it is okay to switch methodologies. So GIPS allows 3 methodologies to be used. We have the aggregate method, which is going to be more of creating one single portfolio, like a broad portfolio, and calculating performance off that. The more common methodology we see is asset weighting based on beginning values. That's probably the most widely used methodology. GIPS allows a third that most people and systems aren't using anymore, but it still exists, which is asset weighting with weighted cash flows. Outside of GIPS, we do see firms using the equal weighted method, so more or less just a simple average of those returns in the portfolio. Again, you just need to be consistent and just aware that if you are pursuing GIPS, that equal weighted methodology isn't allowed. So from there, we have our time weighted returns and our money weighted returns. Our time weighted returns are going to be the most common return type that you're seeing in the industry, as these are going to be removing the impact of cash flows. So this is important because with managing separate accounts, they're going to pull money in, take money out as they please, and the manager doesn't have control of that. So we don't want the performance of the manager to be impacted by the account holders' decisions to withdraw or contribute cash. This is going to be more of the true return type that the manager had earned. So Money weighted returns, or IRRs, are going to be more common when your firm is controlling these external cash flows. So we're typically going to see this in the pooled fund landscape, typically closed-end funds where the manager is controlling exactly how much cash is entering or leaving the pooled vehicle and at a specific time. So again, you're only really going to use money weighted returns if you have total control over those cash flows. And if it is a composite, you need to have total control of the cash flows for every constituent in that composite. In terms of the frequency of data, the minimum requirement for GIPS and most regulatory bodies is to produce monthly returns. From there, you would link those for any other return period you need to show. It is very common now for portfolio accounting systems to do these, which is great. I'd say that's kind of the gold standard for calculating a time-weighted return, as that's revaluing your portfolio every single day. And again, producing that most accurate return, but you only need to produce the monthly return. So more or less that daily data is behind the scenes. For private market investments, it is common for quarterly returns and quarterly valuations, as these are going to be a little bit more illiquid and hard to value. So GIPS at least is not making you go get those valuations every single month. So really the goal of composites is to create a meaningful presentation of how you manage the strategy. And there's no better way to show how you did as a strategy than showing the actual accounts within that. With that being said, we do want to have some control over that to ensure that what you're producing is meaningful. So a composite is typically going to be defined around an investment mandate. So someone signing up for your large cap strategy or your international strategy. And that's typically going to kind of be that first threshold of what's in your composite. From there, we just want to make sure that those accounts make sense to be in that composite. So under GIPS, you are required to exclude accounts that have material restrictions. So any restrictions that's going to impact your ability to implement the strategy. And what we call that under GIPS is your definition of discretion. So at what point does a client's restriction take away from the strategy that you're offering? So this can be everything from if legacy assets exceed 10% of the portfolio's value. That could be a reason that the account's excluded, or they have consistent cash flows. You can really tailor this to what makes the most sense for your firm. Obviously, if you want to purely just manage your strategy, you don't want any outside noise, you could make that definition of discretion more or less a 0% threshold. So any size restriction is going to result in exclusion of these accounts. You could have it a little bit looser. You know that your clients are going to have legacy positions and cash flows and all of that. You could make it looser and say 10 or 15% of the portfolio needs to be restricted. But again, the goal of this is to be able to create that meaningful performance comparison. Outside of GIPS, I still think that some form of this definition of discretion is still a best practice. Again, as it's just giving you control to make sure you have the correct accounts in there. Just because they're signed up for this composite or meet that composite's description doesn't mean that it's going to stay in there. And one thing to note with GIPS is that if an account is excluded from a composite because it's violating this definition of discretion or some of these other policies we're about to discuss, you don't need to put them in another composite. I think that's a very common preconceived notion with GIPS, as it says everything needs to be in a composite. It's really everything that's discretionary that needs to be in a composite. It's fine to have a whole pool of accounts that are excluded due to restrictions. Some other policies that are going to help keep that performance meaningful. First is minimum account size. So really what this is getting at, any accounts below your defined threshold are going to be excluded from the composite. What this is saying is it takes at least this amount of money to be able to fully invest in the strategy. This does not have to be the same as your marketing minimum. This can be, if it's really $100,000 to implement the strategy, then you would be able to use that, but market something much, much higher if that's what you wanted. So you do have control over this. This can be defined on a composite by composite basis. So really GIPs or not, you have a lot of flexibility with these policies to make it make the most sense for you and your firm. Next, we have our significant cash flows. Standard inflows and outflows out of an account is not typically a valid reason for exclusion. There has to be a restriction around it, such as we need you to dollar cost average these assets into the strategy, or you implement this significant cash flow policy that says any cash flows over X%, the account's going to be excluded for that month. So thinking of if an account had contributed double the account size into the portfolio, there's likely going to be some time it takes to get that invested, and you're going to have a cash drag if that performance is going up. So having this significant cash flow policy could prevent the kind of cash drag pulling performance down because the client invested so much cash. The last couple policies is going to be your inclusion policy, your terminated account policy, and then your change in strategy policy. The terminated policy, that's going to be pretty straightforward across the board for pretty much any firm in the world, and that's going to be the account is excluded through the last full month it's being managed. So an account closes today, it would be included in the composite through September 30th. Change in mandate policy, typically you're going to follow your terminated account and your new account policy. For your new account policy, this is where you again have a lot of freedom to craft something that makes sense for your firm. So there's the two most common inclusion policies is going to be a time-based policy and a percent invested policy. The percent invested policy says it needs to be at least X% invested, typically 90 or 100% before it's included. That sounds very appealing, but it's a lot of work. You have to check how invested they are every single month until they've become fully invested. Alternatively, and what we recommend to all of the firms that we work with is to use a time-based policy. For each composite as the firm on a whole, consider an account coming in with 100% cash. How long does that take you on average to get it invested? If it's 4 weeks on average, then what I would recommend is that your policy is it enters the beginning of the second full month under management. So an account that comes in today is going to enter the composite at the beginning of December. So there is a trade-off with this. It is a much simpler policy to apply. The account comes in, you know exactly when it's going to go in, but it might be fully invested before that time period, or it may not be 100% invested after. So you do end up with a little bit of noise, but you are using a policy that's easier to manage.
So in building composites, it's important to get buy-in from the full team. It's a lot easier to make adjustments earlier in the construction process rather than later. So that can include compliance, sales, your marketing team, just making sure that everyone's on the same page for how you're going to define the composite and how it's going to be held out to the public is very important. That being said, this is easier when composites are created from some kind of predefined mandate where clients are clearly signing up for, say, your large cap value strategy. Firms can also create a composite down the road once they realize they have a strategy they can market. So say you're primarily an equity firm, but you're allowing your clients to come in with some fixed income portfolios. Maybe down the road, you realize this fixed income strategy is a good one and it's something you want to offer to the public. At that time, you can create that fixed income composite. Or if there are accounts with similar restrictions, that's another example where maybe you make a socially aware version of that large cap value strategy, removing any tobacco or alcohol, and you offer that strategy to new prospects. When it comes down to marketing the composites and what's required, under most regulatory environments, you only need to make a composite for what you are marketing. GIPS is a bit stricter, requiring all discretionary fee-paying accounts to be included in at least one composite. In that first example with the inherited fixed income accounts, there are no restrictions on those accounts, then you would need to create a composite for them regardless of whether you plan to market that strategy or not. And that'll be the biggest difference in how many composites that your firm needs to create. But again, if accounts are violating that definition of discretion or the minimum policy, then those accounts do not need to be in a composite. Some other types of composites that we are seeing are asset allocation composites. So for example, a balanced strategy where maybe you're allowing a range of 40 to 60% equity or fixed income. This is something we're seeing growing in popularity, especially where there isn't a clearly defined strategy like in that large cap value example. Some things to consider with asset allocation composites is that you need to make sure that those bands are meaningful. So if you're allowing 30 to 70% equity, this might not be the most meaningful composite, and there likely will be a lot of dispersion, a lot of noise in there. So making sure that those bands make sense, along with maybe also having some additional requirements. So for example, maybe you want to make sure you don't end up with one account with, say, 95% Apple with the rest cash that otherwise meets that allocation band. That's probably going to look a lot different than your other accounts. So you may need to implement other rules to keep these composites meaningful. Another thing to be wary of with asset allocation composites is market fluctuations. So those market fluctuations could cause those asset allocations to shift from one band to another. Under GIPS, you're only allowed to change the composite if that is a client mandated decision. So if the client's the one requesting to change from, say, moderately aggressive to aggressive. There are no set rules around this from at least a US regulatory perspective. So whatever route you go down just needs to be properly documented and consistently applied. We highly recommend following the GIPS protocol for this, as it does help create more meaningful composites. When discussing composites, people's thoughts typically go to separately managed accounts. For pooled funds, there are still plenty of ways to show these as composites. The most common is when firms are trying to attract separate account investors for a strategy they also manage as a fund. So rather than presenting a vehicle to invest in, they're presenting the strategy as a whole. Or maybe there are instances where the strategy was historically offered as a pooled fund or specifically for separate accounts, and down the road this changes. If you want to link that performance to present it as one continuous strategy, you would do so through the use of a composite, as a composite can include both separate accounts and pooled funds. Firms managing just pooled funds can also claim GIPS compliance. GIPS differentiates between private funds and publicly available funds, referring to the former as limited distribution and the latter as a broad distribution pooled funds in most cases. Limited distribution pooled funds need to either be included in a composite or have a GIPS pooled fund report created, with some requirements that vary from the composite reports. A broad distribution pooled fund only needs to be included in a composite if there is an existing strategy it meets the composite definition for. Otherwise, you are not required to distribute a pooled fund report, which can greatly simplify claiming compliance for firms managing just broad distribution pooled funds.
So at this point, we've identified our composites. We've reviewed the constituents in there as it relates to the various policies. Now we're kind of on to our final reviews to validate that this performance is accurate. So first way of doing that is looking at the dispersion. So that's going to be measuring the spread of returns for the portfolios in a composite for the period. So when you're looking at dispersion, whether it's monthly, quarterly, or annual, it's only going to be the accounts that were included for that entire period. So if it's annual, only accounts included for the entire period. If an account had entered halfway through the period, it wouldn't be in that calculation. So again, it gives you a better idea of that, how tightly managed are your composites. With dispersion, it's important to note that there is no right or wrong dispersion. There's dispersion that makes sense and there's dispersion that doesn't make sense. So in our first example, if you consider a passive fixed income strategy, you're not allowing a lot of restrictions from your clients. Typically, we're going to see that annual dispersion less than 1%. Everything should be pretty closely managed in the same way. But on the other hand, you might be running an active equity strategy. There may be restrictions that you're allowing from your various clients. There's going to be little differences. So dispersion of 3 to 5% could make sense. Asset allocation composites, we can definitely see these creeping above 5%. But again, it's what makes sense. I'd say as you start to get to 8 to 10% dispersion, that's where it becomes a little less meaningful. And at that time, you would want to take a step back and really make sure, is this composite meaningful, or did maybe we broaden the definition too much and we're allowing too many different accounts in here? Maybe there's accounts that we missed that need to be excluded. How we can catch these accounts is an outlier review. So this is going to be done on a monthly basis, and it's really going to take that accounts return and compare it to the composites return and determine how many standard deviations away that accounts return is. So unless every single account has the same exact return as the composite, you're going to have outliers. What's really important is to review the most extreme outliers. I would say doing this outlier review has been by far the most meaningful and successful review that our clients do. Pretty much any issues that we've ran into doing the composite build has been captured during this outlier review. Our recommendation is that you're doing this at least annually. I would say doing it annually could result in quite a few accounts that you need to review. So our recommendation is monthly or quarterly is about the norm that we're seeing for this review. And just because an account is flagged as an outlier doesn't necessarily mean that there's an issue. You just want to validate the performance or find a valid reason for exclusion that may have been missed when you were originally constructing the composite. Doing this review before distributing marketing materials, I'd say, is very important. This just really reduces that chance of having an error in the performance that you're presenting. A review that is helpful is looking at the highest and lowest annual performer for each year. This is something that at least all GIPS verifiers and regulators are aware of. So what they'll do is take an account that's returned 20% at the high end. They'll see an account that performed at 0%. That 20% spread is quite high, and they'll have you prove that those accounts belong in the same composite. So this is one of those reviews that you're more or less kind of beating verifiers and regulators to the punch, and you're getting that review done first so that there are no issues down the road. Kind of the last piece of review is going to be review of those non-discretionary accounts, or the accounts that are restricted that we excluded due to that definition of discretion or your minimum account size. It is very easy to exclude an account and just forget about it. It's not in a composite. It's not showing up in this outlier review or this dispersion review. But it's important to review that on at least an annual basis. Again, annual is kind of the norm for GIPS, at least the regulatory body here in the US. So just going through it, this doesn't need to be a complicated review. What we do for our clients is we'll basically make a list of every account that's excluded and just ask them to scroll through that list, making sure nothing jumps out at them as something that has the restriction removed and should be re-entered into a composite. These are accounts that will be reviewed by your GIPS verifier or regulator if you were to be examined. So kind of the next piece of reviewing and presenting performance is going to be your benchmark and appraisal statistics. The goal with a benchmark is to show a meaningful comparison. That can mean a lot of different things depending on your strategy and your audience. But first, I think it's good to identify the various types of benchmarks that you have available. So you have your standard total return indices, such as the MSCI ACWI index. There's ETF versions of these benchmarks that we're seeing being used more and more, as these are free and available to the public. They also reflect additional costs and expenses that total return indices do not have. So a lot of firms argue that this is more meaningful because our clients are going to be paying fees and expenses, so why shouldn't the benchmark that we're using do the same? There is no right or wrong way. Just make sure that you're comfortable with whatever you're using. The total return indices usually come with licensing fees. So smaller firms like to use the ETFs as a way to save money and still have that meaningful comparison. You are able to blend benchmarks. So if you have a balanced strategy that's 50% equity, 50% fixed income, you could blend two indices together. Under GIPS, you have to call it a custom blended benchmark because that blend does not actually exist elsewhere. You can, in terms of your rebalancing on that, how often you're going back to that 50% weight, you really have two options. The first option is to do what the industry norm is, and that's to rebalance this on a monthly basis. Second option is to match how often you're rebalancing the strategy. So whether that's daily, monthly, quarterly, annually, you can choose when you're rebalancing to kind of make it an even more meaningful comparison, because that's what your strategy is doing as well. So when you're thinking, okay, which benchmark should I choose? Should I blend? You need to balance market indicators. So if you were primarily marketing to retail investors that may not have a lot of experience, having some complicated custom benchmark with multiple components may not be meaningful, as they may not understand it. They may just need to see something like the MSCI ACWI that gives them a broader picture of the market, because that's something that they're aware of, or the S&P 500. If you were to market to, say, an institutional investor and you have a balanced strategy, the expectation is typically that you are creating that blended benchmark that does represent the strategy. It's not uncommon for firms to be showing multiple benchmarks. So you may have a custom blended benchmark, and then you may have the MSCI ACWI shown as well, with maybe a disclosure that it is a broad market indicator. So again, GIPS or your regulatory body isn't going to necessarily tell you this is exactly the benchmarks you need to use. You just need to consider what's a meaningful comparison for the type of prospect that we're presenting. If you have both retail and institutional investors, you could create two different versions of the composite, where one's being managed to that blended benchmark and the other's being compared to that simple broad market benchmark. So your appraisal statistics, we'll talk about this from a marketing view in a couple slides, but in terms of a review, this is just, there's so many ways to review your performance and make sure it's accurate. Appraisal statistics are going to help you review that the story that you're telling matches what happened. So these are going to be everything from your alpha, your beta, your Sharpe, your upmarket capture ratios. In terms of what you review, you want it to make sense for your strategy. So if you're focused on limiting downside loss, it's probably more relevant for you to review your Sortino ratio than your Sharpe ratio. And what's important is you don't want to just look since inception or the last year. Look over all periods and see, are there any trends in the data? Were there any years that seem very different from others? A good example of this is back in 2020 with COVID. We've seen a lot of these statistics deviate from what was expected. Just reviewing it and making sure that makes sense for that time period is really what's important with using these. But again, with this internal review, you can use all or none appraisal statistics. But again, this is really just to help prove that your story is being told correctly.
So the GIPS requirements really are considered best practice. GIPS is recognized worldwide and really fosters that apples to apples comparison across different managers of similar strategies. We're also seeing GIPS become more of a database requirement. A lot of databases are not allowing firms to join their platform until they're GIPS compliant. If you're on a platform but not claiming GIPS compliance, we're seeing a lot of institutional clients using these databases to specifically filter out firms that are not GIPS compliant or verified. GIPS in general is becoming a more relevant search criteria for investors. That being said, the GIPS standards have been adaptive to become more inclusive of different types of firms and vehicles. A decade ago, the notion was maybe that GIPS was more geared toward your traditional investment manager. Since then, GIPS has made it easier for firms focused on pooled vehicles as well as private equity, also asset owners. As they're continuing to try to make the standards as easy to follow as possible and releasing guidance statements every couple years to help clarify the application of the standards. They're also looking at the standards as a whole and completely rewriting parts when needed to stay on top of changes in the industry. The frequency of updates to the GIPS standards and the resources available are really geared to give as much guidance as possible and make it as easy as possible for different types of firms to claim and maintain GIPS compliance. Another example of where the standards have adapted is the allowed methodologies for calculating account level performance. Not every firm has access to a portfolio accounting system able to calculate a daily time-weighted return, which is considered the gold standard. GIPS does allow for approximate time-weighted returns, where you maybe need less data points for those firms that don't have the same resources for calculating performance and may just be using custodian statements and manual calculations. That all being said, the GIPS standards do allow for a lot of flexibility. If local laws and regulations differ from the GIPS standards, this doesn't mean that you cannot claim GIPS compliance. In this case, you would comply with those local regulations and disclose any conflict in the GIPS report. So conflicts aren't necessarily a reason for a firm to not work towards GIPS compliance. At least in the States, there is a lot of overlap between the GIPS standards and regulatory requirements, but we still do see conflicts. For example, a firm may choose to initially claim GIPS compliance for a track record of 5 years, while they have performance going back further than that for the strategy. The GIPS standards do not allow you to link your GIPS track record with periods for which you do not claim GIPS compliance. But the Security Exchange Commission in the States requires firms to present a 10-year performance number for strategies that go back that far. Firms in this situation have been presenting that 10-year performance number, linking their GIPS compliant track record with the non-compliant performance, and including a disclosure of this in the GIPS report. If unsure how to deal with any specific circumstances or interpret any of the standards, another resource available is the GIPS Help Desk. Firms are welcome to send an email to the help desk and can typically expect a response within 3 business days. With the flexibility of the GIPS standards and all the resources available, claiming compliance with the standards is more accessible than ever for firms of all types and sizes.
So really GIPS, not worried about GIPS, anything like that. Really the goal is to get to marketing. And having something that you can show and present, because marketing, especially fact sheets, is as common and beneficial as ever. The use of fact sheets, I would say, is probably the most common way to market your performance. You have databases, which you have on your website, pitch books, anything like that, but really these 1 to 2 page fact sheets, like the one that you're seeing right now, is going to be really kind of the gold standard of marketing. So in terms of trends that we're seeing, monthly or quarterly updates are going to be the most common, with quarterly being the vast majority of the updates. We're not really seeing firms update less frequently than quarterly. Monthly it could be a lot of work, but if there are needs for monthly, by all means do so. But I would say quarterly is a good goal. And really what we've seen is fact sheets that have really been improved with overall design and flow as technology is improved. I mean, 7 years ago, the first GIPS report that I had seen was just this black and white single page. And now pretty much every firm has their logos and colors added to it. We see these fact sheets that just look a lot crisper than, say, a decade or 2 ago. And it's important to kind of stay up to date with that change in technology or change in what kind of the norm is on these fact sheets. So regardless of whatever distribution method you have, consider the time it takes to update these fact sheets. The more you have driven by performance, the faster these fact sheets are going to be updated. You already have these calculations done for your composite, so it's easy to swap out your growth of a million chart or swap out your trailing returns table. If you start to have pieces like market commentary and all of that, it takes a little bit of time to write that, and it can slow down your overall process to update your marketing materials. So I'd say the more pieces you have driven by performance and stuff you can pull from your software, the faster you're going to get this updated. I'd say most firms quarterly are trying to have their fact sheets updated by the middle of the month. That kind of aligns with database requirements for updating your performance. But there really is no right or wrong. Are you updating it in time for your prospects to have that fact sheet, or do they need your fact sheet to be updated as soon as possible every quarter? Things to consider on what you're putting in there. Again, think of the story that you're putting in there. You don't want to overcomplicate this. You don't want to be putting in things that don't make sense. Again, if you are trying to focus on minimizing downside loss, you could put in your downside capture ratio and show how you're doing in those down markets. But with anything, it's important to make sure that this is fair and balanced. So if you are going to show that downside capture ratio, make sure you're also showing your upside capture ratio that tells the story on the other side of things. If you're showing your top performers, make sure you're showing an equal number of your worst performers. So fair and balanced, telling the story that makes sense. I'd say what you see here is about the max that we see in any given fact sheet. So you have your growth of a million, your table of trailing returns, some various metrics, and then information on holdings, and then that case study. In terms of disclosures, make sure that these are being reviewed by compliance or legal on an annual basis. While these stay pretty stagnant year in and year out, things will change. Whether it's due to regulatory changes or something changed in the composite, just make sure you are reviewing those and not letting those disclosures get stale. But again, this is the goal of all of it, is to be able to market it, whether you're GIPS or not. If you are GIPS compliant, you do have the option to mention GIPS in your fact sheet, or you don't have to mention it all. So you have a lot of flexibility regardless of the situation that you're in. With that being said, that is all we had for you. We wanted to allow as much time as possible for Q&A. If there are kind of unique scenarios to your firm, you guys are more than welcome to reach out to us, and we're happy to chat through it. Feel free to add any questions in the chat feature or raise your hand. But while you guys are doing that, I'll kick off a question for Sarah. I'd say, what is the hardest part about claiming GIPS compliance, Sarah?
Hardest part about claiming GIPS compliance. I would say it's typically just that initial build. Like I had mentioned earlier, getting everyone on the same page of kind of what you're trying to market as a company, what type of performance you're trying to present, what type of strategies that you're trying to offer, and just kind of that initial construction. That initial outlier review can typically be pretty robust depending on how far back you're going, how many accounts you have. So a lot of firms, they might struggle a little bit through that. And with that, we just tell them, once they get that initial performance down, it's a lot easier going forward whenever you're reviewing those reviewing outliers on a quarterly or monthly basis going forward.
There's a lot to GIPS, but a lot of it is so that there is flexibility. There are a lot of provisions that are not one size fit all. Just try to manage what makes the most sense for your firm. Can definitely be a bit time consuming. but that's also where firms like Longs Peak can be of help. But I'd say the firm claiming compliance is definitely growing, so I'd always say at least consider it, regardless of the challenges or barriers that you may face with it. I think after a lot of mergers and acquisitions, I think the most recent count was about 1,800 firms claiming compliance worldwide right now. So it's definitely a more common thing now.
Hi, Cameron. I got a question.
Yeah.
In Indonesia, there's still no company that has claimed compliance. But how do you guys, if we have a firm here in Indonesia that's interested in claiming compliance, how can Long Peaks help us?
Yeah. So really, we try to be a part of your performance department. We try to do the hands-on work to help you become compliant, figuring out which provisions are relevant, how we should be constructing these composites. We're really holding your hand through this process. I would say that for any one of you on the call, you guys could very well be the first firm in Indonesia claiming compliance, which I always think is very cool. Usually at the GIPS conference, they'll say something about it, but I don't think it's difficult. It can just be time consuming, but we're here to help you along the way. And really what that process looks like is starting by having a kickoff call, drafting those policies and procedures, and keeping it simple at first, considering, okay, what is our membership policy that we want to start with? And then from there, then we get into the hands-on data, start to construct these composites. But with the use of our software, it's very easy to make little changes. You see the data, you're like, okay, maybe this doesn't make the most sense, or let's tweak this thing or the other. We're here to help make those changes, review that performance with you, and let you know what our thoughts are on it. So really our goal is so that you're not going into this blind or overwhelmed by it. We're really telling you exactly what you need to be worried about as it pertains to GIPS.
Silakan ya, kalau ada yang mau nanya, unmute aja, langsung bicara.
There's no other questions. Again, if there's stuff specific to your firm or anything like that you want to chat through, by all means, please don't hesitate to reach out. Always happy to chat through it and see what it would look like to help your firm become GIPS compliant. Or maybe you start with just creating composites to see how that process goes, and then consider GIPS for the rest of your firm down the road. That's definitely an approach we see. But definitely at a minimum, consider, have you created composites, and where are you at with that marketing performance compared to other firms around the world?
Usually, how long does it take to claim compliance, Cameron?
It depends on every firm. Every firm is going to be a little bit different. If you know exactly where the accounts, what composites your account should go in, you have the resources to work on the project quickly, it can be as short as a month. If this is something you want to take your time with, you want to work through it as you have the resources, it can be many months. It's really what makes the most sense for your firm. You obviously don't want to overdo it and strain yourself and work extra hours to try to get it done in a couple weeks if you don't need that right away. You can take your time and build it. So it really depends on you. But I mean, the quickest I've ever gotten a firm compliant was a week and a half. It was a very small firm, but it is possible to do it quickly. We've had firms that decided to take a year. So there is no right or wrong. It just is the amount of resources you have available at that time.
Okay.
Any other questions? No other questions. I think that's everything we had. And again, we'll share the detailed slide deck with the society, so you guys have that at your disposal.
All right. Thank you, Cameron. Thank you, Sarah. Thank you, everyone. Have you a good morning and good evening. Goodbye.
Thank you. Bye, guys.
Thank you. Have a good one.